Good evening, and you're all very welcome to this evening's webinar, which is being brought to you tonight by the advisory staff here in County Mayo. My name is Brendan Gary, and I work in Teagasc and Ballinrobe, and tonight, for the next hour, I'm delighted to be your host for this evening's webinar. Now, this evening's webinar is the third episode in a new 7-part series of webinars, which will run throughout the month of January and for 3 weeks into February, and each Tuesday night at 8 p.m. And the same link will work for each episode. Now, during this series, we will cover some of the key agricultural issues facing Irish farmers in 2024. Tonight, the focus switches to planning for farm succession, and I'm delighted to be joined tonight by Deborah Dwyer from the Citizens Information Service, and Deborah is going to talk to us about the Fair Deal scheme, which is operated by the HSE, while later we will be joined by James McDonnell from Teagasc in Oak Park, and James is going to talk to us about the factors to consider to ensure an effective farm transfer and a smooth succession process takes place on your farm. Now, you, the viewers, are being encouraged to engage with our speakers here tonight. We ask you, as always, to type your questions into the Q&A button at the bottom of your screens, phones or tablets. And later this evening, Vivian Silk, the Teagasc Regional Manager here in County Mayo, will put your questions live to our panellists. So indeed, type your questions throughout the night into the Q&A box. As always, this webinar is being recorded and will be available to watch back on the Teagasc Mayo YouTube channel within the coming days. So without further delay, I'll now ask you, Deborah, to start sharing your presentation with us, and it's over to you now, Deborah.
Good evening to all your participants, and thank you again, Brendan and James, for the invite to present to your audience and members of Teagasc. Previously, I've covered pensions and Fair Deal, and both of them are always heavy topics. So this evening, my presentation is a selection of slides, and the overall pack then has been sent to Brendan and James, so that you will have as an audience, you will have a handout with the full level of detail around Fair Deal, which is what I'm covering tonight. As with any presentation, why you should come and visit Citizens Information and how to access is included as well. So because we are nationwide, if you go into our Citizens Information website, on this tab here in the menu, you'll see Find a Centre. And that will bring you to an interactive map where you can check every county and where your local Citizens Information Centre is, their opening hours, their telephone number and their email. And then to show you on the website that it's categorized by subject area. So here you'll see, for example, health related queries, and then under health, you'll see the Fair Deal as a topic. Coming to Citizens Information allows you to get a benefits check done, or for us to make sure that you are on the right payment at the right time. There's a whole host of payments that are available through the Department of Social Protection primarily. Some of these are based on your PRSI contributions. Some of them are allowances that are means tested. Some of them have different eligibility criteria. And indeed, some of them might be schemes with administrative rules rather than legislative rules. And Citizens Information is well placed to help you with all of the payments that may be available for your personal circumstances at the day. Oh, beg your pardon. So the other thing I wanted to bring to your attention was that because we're just into January now, the budget last year brought in a number of changes, and they would have come effective since the 1st of January. There are some other changes that are due in February and some other changes that are due later in the year. But anybody who is in receipt of a social welfare payment will know that their payment has increased by €12 per for the primary claimant per week. And then there are other changes on the domiciliary care and changes with regards to the foster care. The slides in your plaque will have a further list of things that are coming into effect. For example, there's changes to the statutory sick pay, minimum wage has changed. There are changes to grants such as solar panel grant. There's changes to tax credits. There's the widening of the USC bands. There's also an opt-in or a change to the age of pension where you can choose to apply for your pension from 66 to 70. There's brown bins being released. There's new legislation around tips gratuity. So the list is endless. So Citizens Information as a website and a service is a good port to call. And one of the things that we offer as a service is assistance with the Fair Deal application process. And Fair Deal is what we call a perfect storm. Normally when people are considering or starting down the road of applying for Fair Deal, it's because somebody, either themselves or in their family, have received maybe an analysis or a diagnosis that requires a long-term care treatment plan, or they may be indeed facing end-of-life care and treatment. And this is an emotionally intense time. And the Fair Deal application form is 40 pages long. It has 3 parts to it. It's quite complex. And that on top of emotions can increase the pressure in the family home or in the family unit. So today the presentation is going to look at what are the 3 elements to the presentation and how do you apply and what happens then if things like a change in circumstances happen or you've been refused. What you do need to know is that there is a checklist within the application form, and that should be your starting point. Get 2 copies of the application form. Read it thoroughly. Pull out page 5, the checklist that gives you all the hints and a list of documents that you need. And use one application form for your first run at filling it out. And then when you're practiced in it, then you can use this backup form for your final application. It will allow you to gather up evidence, and in fact, it's required for the financial assessment part of it. And this is more than a budget sheet, but for those of you that are starting this whole process for the first time, our sister company, the Money Advice Budgeting Service, mabs.ie, there is their website, have an excellent budget sheet that you can use as a template. And it prompts you to consider all sorts of things that you need to consider for daily living, from mortgage and rent to travel to work costs to utilities to annual insurance policies to childcare costs, as well as your weekly shopping and your social life as well. So without further ado, let's look at the 3 elements. So the first part is that a care needs assessment will be done. This will be done by a medical professional. They will either want you to go to the clinic or to the hospital, or they may indeed do a home visit. They will be looking at to see what care needs you have with regards to how mobile are you during your daily activities, what medication are you on, what health needs do you have, are you getting other social services or health services provided to you, do you have a family support unit, maybe you're getting some community help. And then they'll also talk to you around your own wishes and preferences. It might include physical examination, and what you will know afterwards is that a report will be given to you, and that will be provided to you as the applicant, as well as being submitted to the HSE. The next part then, if I just go back, is the financial assessment. So the second part is the financial assessment, and this is where I mentioned about budgeting. But this is where it will consider all your information around your income and your assets, and it is a calculation that is put in place by the form and the HSE to work out what your contribution to your care is going to be. And the HSE then, if you qualify, will pay the balance of your care costs. What you need to know is that your income includes any earnings, pension income, maybe from a private pension, any social welfare payments that you're in receipt of, any monies that you earn from maybe renting out a second house or even rooms in the family home, income from holding any kind of directorship or officer within business, any kind of commissions or dividends that you get for savings accounts, or any other income that and they'll also check to see, have you put anything out of their reach in the last 5 years before your application goes in. So all of that needs to be documented within the financial assessment part of the application form. It requires you to go to your bank accounts, credit union accounts, post office savings, stocks, bonds, prize bonds, etc., and to get a statement of balance from them. So like your bank statement, it must be within 3 months. Same for the credit union. So also if you had a second principal residence, that you would go to the estate agents and get a valuation done on that, so that you can show that you are giving true and accurate information. There are some safeguards built into the whole financial assessment, so nobody will pay more than the actual cost of care. If you are receiving a social welfare payment, such as a state pension each week, you will be able to keep a personal allowance of 20% of their income per week, and the rest of the pension is moved towards the cost of care. However, if you have a person has a spouse or a partner remaining at home, they'll be left with 50% of the couple's income or the maximum rate of the state pension. So those safeguards are built in. It's important, therefore, that when you fill out the form, that you put in the information around your whole family structure. So are you married or in a partnership, and if you have dependent children, etc. So with regards to how much you pay towards the cost of your care, the asset of a person's principal residence is taken into account for the first 3 years of care. This means that a maximum cap of 22% of the value of the home can be taken into account. Now, where there are couples and one party still lives in the home, this is capped at 11.25% over the 3 years. And if you're part of a couple and you will contribute half of the amount above, that is 40% of your income or 3.75% of the value of your assets per year. So, and those figures are in relation to the first 36,000 of your assets for a single person or 72,000 for a couple, are disregarded, as they call it in the business. So the nursing home loan, before I move on to that, we'll just say about the principal residence. If you have other properties that you have rented and you're getting rental income from them, it is important that you have them registered with the tenancies board, the residential tenancies board, as you are a landlord. And all properties that are in the under a rental agreement must be registered with that outfit. And if you haven't registered them so far, now is the time to get in touch with them and ask them for a direction and some information and support around registering. Be warned that they may hit you with a penalty, but it is easier to have that penalty known to you now and for you to communicate and liaise with the Residence Tenancies Board around that payment, rather than applying for fair deal and then finding that you have disqualified yourself because of not meeting one of the particular terms of eligibility. With regards to the nursing home loan, this is an optional step. It should be completed if you wish to apply for the nursing home support scheme. Once you are approved, the HSE will pay the money to the nursing home on your behalf, and then the HSE will collect that amount of money through a charge order once you have passed on. And if you are part of a couple and you are going down this road, then both spouses must sign for this charge order. So it cannot be done with only one person's signature. Both spouses must sign the charge order. So the charge order is like a mortgage or a type of mortgage. It secures the money loaned by the HSE. It has some legal binding with it, and it has terms and conditions around it. So you cannot just go off and sell the house. You must do that with notice and approval from the HSE so that they recoup the loan first. Likewise, if there is an estate that has been managed through probate, you cannot divide the assets of the estate until you notify the HSE that this is going to happen and that they clear it for that to happen, because there's a charge order in place. So what does Fair Deal cover? It covers the accommodation and food, the nursing and personal care that you may need, your laundry services, some basic aids and appliances necessary to support you while you're receiving care or living in the nursing home. There are other things that are provided by the nursing home that the Fair Deal does not cover. They are things around activities or daycare outings or other fees or charges like hairdressing or some other kind of spa-like treatments, or maybe social activities or outings, etc. If you're on medication, you should check and see that if you have a medical card or if that covers them. And if so, use the generic type of medication. And if you're not qualified for a medical card, then you should be registered through the pharmacy for your drugs payment scheme. The 3-year cap is a question that comes into us quite a lot. And just to explain that it's based on the certain value of the assets of your home. So your home, the proceeds from the sale of your home, and it's also for your farm or business. You contribute 7.5% of the value for a maximum of 3 years. So that's where the 22% comes from. 3 times 7.5 is the 22. And the 3-year cap, whether you take out the option to have the loan drawn down and paid out by the HSE and then recouped or not, that 3-year cap still applies. If you want to apply for it for your farm or business to be included in it, then you must fill out Part 6 of the application form. You must meet a number of conditions around it. For example, it looks at you to make sure that you have some kind of family successor in place that is going to run the farm or the business, that your farm is actively run by you or your partner or your proposed successor for at least 3 of the last 5 years, and that the charge order in favour of the HSE is placed and signed up by all parties. With regards to the successor, they must be 18 or over. They can be your partner or a relative or your partner's relative. So a relative then is a child, a grandchild, a brother or a stepbrother, a sister or a stepsister, an uncle or an aunt, or anyone that kind of fits in your family tree, like a niece or a nephew, or maybe even a son-in-law or a daughter-in-law. To appoint your successor, you need to fill out the Part 7 of the Fair Deal application form. And this requires supporting documents, so affidavits. So they are signed, noted documents that you would get somebody either in a law centre or a solicitor's office or a commissioner for oaths to witness and stamp for you. You should do this as soon as you can, so your successor can begin the 6-year period that they must commit to running the family farm or business. And this commitment begins from the day they are formally appointed. Your successor cannot be appointed until you are in care, and the HSE will review your appointed successor to make sure that they comply with the conditions of the scheme. So, like I said at the start of the presentation, it is a complicated and complex form. There are 7 parts to it. There is a good hint guide on page 5, and there's a reference check guide and checklist that you should keep by your side while you're filling out the form. Make copies of it, get practiced at it. Always feel free to drop in citizens' information with your form. Any of the information officers on duty will be able to step through the form and make sure that you have understood all the questions and you have the supporting documentation and you have included everything. Only the HSE can make an assessment on what's contained in your application form. So it's very important that you get this done the first time round. What I can say to you is that HSE Live, they have an excellent telephone support unit 7 days a week. Now, their hours at the weekend are shorter than their working days, but you'll see their telephone number is 1800 700 700. And they have people in different regional areas dedicated to Fair Deal and the queries and the frequently asked questions that come in by phone. And they are really good support. In fact, we are in Citizens Information use them quite regularly as well when we get difficult questions, particularly relating around to succession planning and transferring of ownership of deeds, etc. What happens then when you send in your application form? The HSE make an assessment based on the information that you have provided. They check the care report to see that the care is matching the care needs. They check the financial assessment part to make sure that you're qualifying under that and that you meet all the eligibility criteria. and they look to see that the nursing home that you've selected is part of the scheme. With regards to the nursing home, you have to check and see that they have a place for you and that they meet the needs for the patient. And there's probably an extra piece of work that the nursing home needs to do there. The payment will be the same for a voluntary private or a public nursing home. And if your circumstances change, you can request another financial review 12 months after your first assessment. And then the HSE, though, can opt in to make a financial assessment at any stage. So they limit you, but they're not limited. The HSE will start paying only from the date the application is approved. And that is the date that they say you should be admitted to the nursing home. Often there might be a misalignment there. So people need to move out of hospital into a nursing home faster than the fair deal application has come back to them. And people need to be careful there because they could be held accountable for that cost. So watch for that and make sure that you get all formal records and correspondence from the HSE with regards to the covering of the costs and when the date is approved from. At the end of the presentation, I've included some useful links. You'll see there around Fair Deal, and you'll see there around the HSE, and indeed your own website has a previous booklet around supports. So they are useful links to dip in and out of. I wouldn't anticipate anybody reading everything about it, but it's good to use it as kind of a glossary and a quick reference. If you need extra attention or support, you're welcome to come to the Westmeath office by email. It's easier for us to deal with queries that have some content included in it. So that gives us a more structured answer for you rather than a generic answer, which would include a reference back to the HSE website and our own website. And then it's just to check to see if you have any questions on this. Like I said, the presentation pack that you as audience members will get has a lot more detail included in it. But for the purposes of a presentation, I'm quite happy that you know where citizens' information are. You know that we cover Fair Deal. You know that you're welcome into us if you have started your application form and you meet a barrier towards that, or you need a hand preparing some of the budgetary pieces or finding out who's going to do your care need assessment in your neighbourhood. So I see there's some questions coming in as well.
We can take those again at the end, Deborah.
At the end, okay, perfect. So I am going to stop sharing now. I hope I'm close enough to my time allocation so I haven't ran over on James.
No, you're perfect now, Deborah. Thank you very much for that brilliant presentation. And indeed, look at you, the viewers at home this evening. We have a lot of farmers on this evening, so please put your questions in there. We have some already, and indeed, look, we will pick the questions up there at the very end there. So indeed, at this stage of the evening, our colleague there, James McDonnell from the Teagasc office in Oak Park, is going to talk to us about farm succession planning and indeed some tips to watch out for. So over to you now, James.
Thanks, Brendan, and thanks, Deborah. A lot of information there, Deborah. I learned a little bit too, so that's good. So my talk is really, I suppose, I'm just going to look at two elements, because my screen won't, move on. Yeah, I'm going to focus on two areas. So the first is where you can get help. And the second thing I'm going to do is I'm just going to highlight some key areas where you might need more information on. So where do you get the help and what questions do you ask those people that you're looking for the help from? So I suppose just to put things into context, it's a challenge transferring the farms over from one generation to the next. The average age of farmers now is touching on 60, so it's getting older all the time. So if it was easy, it would happen sooner. And I suppose people are living a little bit longer. So the challenge that you have if you're going to do a farm transfer is the outgoing or the older generation need to be happy. The incoming generation need to be happy. Other family members, because Irish families tend to be big, they all need to be happy after the transaction has taken place. Everybody is clear on their legal and tax implications. Perhaps maybe there's a safety net in place if the plan gets knocked off course or there's a delay for some reason. And, you know, farm families, it's the farm household is often on the farm and the business is there too. So it's keeping a family, you know, communication good, but also it's about keeping a business running. So the farm business, when it passes from one generation to the next, is to keep that thriving as well. And it's a big milestone in a family's history. So there's a lot of moving parts to try and get it right. So I suppose if we look at government and EU policy, it's all about incentivizing people to make early transfers. So, you know, tax policy and incentives are aimed really at young people. And what are the advantages? I suppose, you know, it's easier to plan tax avoidance or tax mitigation strategies when everybody is alive. You never know when somebody passes away, and you know you're locked into the tax situation at that stage. So if everybody is alive and a transfer is going to take place, you can plan your tax situation much better. Deborah mentioned, you know, the 5-year look back in relation to the fair deal. So if a transfer is done early, you know, the assets transfer at least 5 years before somebody may need nursing home care. Well, then, you know, there's no cost against the assets of the farm. It also gives the younger generation time to invest and grow the business. You know, as we get older, we tend to be less ambitious. So, you know, transferring an asset or a business over when people are young gives them time to make steps in maybe improving and you know, growing it. All the tax incentives that we have in Ireland are all aimed at those that are under 35. All of the EU CAP incentives and direct payment incentives, well, they're aimed at those under 40. So to benefit from both, it's better that transfers take place when people are less than 35 years of age. And the other advantage is when everybody is alive, well, it's easier to keep all of the family members happy. That if you pass assets over by will and there's no discussion, well, then there could be a bit of a family row after when the will is being read. So we don't want that. So just in terms of taxes, I'm going to look at them really quickly. So in a lifetime transfer, there are a number of different taxes. So if we look at the transferor, which is generally the older generation, or they're the givers, and the transferee is the receiver or the young person that's receiving the assets. So we look at the transferor. Capital gains tax is the main tax, and there are generally there are two reliefs that you can claim. So there's capital gains tax retirement relief and there's entrepreneurial relief. And the retirement relief is the one that we all aim for. And if you get that right, the retirement relief will cover the tax and there will be no tax on the young person, on the older person. If we look at the younger person then, capital acquisitions tax is the main tax, but you can claim agricultural relief or business relief depending on the situation. But you must try for agricultural relief first. It's a punitive tax, it's 33%, as is capital gains tax. So you will try to plan it in such a way that that tax is not levied on either party. And finally, then the third tax we look at is stamp duty. So to avoid that completely, you transfer the farm when the person is under age 35, so they can claim young trained farm relief, which is 0%. And if the person has been transferred, the land is over 35, well, then you can claim consanguinity relief, which is currently at 1%. So they're fairly strong taxes. So the young person can get caught for two different sets of taxes. And the transfer or the giver gets caught for capital gains tax. Okay. If we do a tax on, if we do a transfer on debt, there's no debt tax. So there's no capital gains tax on the giver. And there's no stamp duty on the transferee. And sometimes, depending on a family situation, the best thing to do to mitigate the tax is to do a transfer on debt. But for the vast majority, a lifetime transfer works out better. So I mentioned financial supports and other incentives. So there's a number of them there listed on the page. I'm not going to go through them in huge detail. You'll get a copy of the slides afterwards. But basically around the latest round of CAP, the direct payments. So there's an additional payment for young farmers, which in 2023 was worth €152 per hectare, up to a maximum of 50 hectares. So if you have a large sized farm that's 50 hectares and you claim that payment for 5 years, it's almost 40,000. So it's a decent payment for young people to get started, and you need to be under 40 to claim that. If the land and the entitlements you're transferred to are below the national average, you can apply for a top-up. If there's investment needed on the farm, you can apply for a higher rate of grant aid as a young person at 60%. And if you want to go and if you decide that, short generation gaps in some families, so parents still want to farm, the young generation want to get started, you could look at a registered farm partnership, and there's grants available to set up those. I think it's a 50% grant, so you could spend €3,000 with your local accountant putting together a farm partnership, and you'll get grant aid. There's also, in relation to this topic of succession planning, a new grant was launched recently where you can go and talk to your solicitor and accountant, and if you pay them a fee for the advice, you can use that invoice. Once you paid, you can claim 50% grant on it, up to €1,500. So that's an incentive to go and get advice, which is important. There's also tax reliefs that are available. So I mentioned already stamp duty relief from young trained farmers, consanguinity relief, which is important as well. There's the agricultural relief from capital acquisitions tax, there's stock relief against income tax, and there's a succession farm partnership income credit. Okay, so in relation to those that you can get help from, so we in Teagasc can give you some help if you talk to your local advisor around the CAP schemes or those schemes that the Department of Agriculture administer. There's the collaborative farming arrangements, and I suppose the Teagasc advisor is a starting point for general queries. Education officers can talk to you about ensuring that the young person receiving the farm has the right qualification. And I believe episode 6 of this series will have an education officer speaking on the different qualifications that a young person would need to qualify for the reliefs. And some people are interested, in forestry. So we also have forestry advisors that you could talk if you wanted to plant some of your farm as part of, stepping back and passing on the land. So there's a whole load of different professionals that are involved in farm succession. So you need an accountant to do your tax returns, because there's capital taxes involved. So there's a CAT, a CGT, and a stamp duty return. You'll need your solicitor to help you write a will. And I suppose the first step that anybody thinking about farm succession is to write a will. And generally, when I'm talking to a farmer audience, if I ask the question, about 50% of people have wills made. And if you don't have a will made, it means that the state decides on what happens to your assets, as per the Succession Act of 1965. So it's very important that you write a will. So you're deciding who your assets go to. So talking to a solicitor about that. And if you want to confer benefits or you want to retain legal security, in some cases farms are transferred, but you might retain right of residence in the house while you're alive. Deborah and Citizens Information Service are a great help in relation to the Fair Deal scheme. Maybe you have pension questions or entitlement questions. The Department of Social Protection, you can go and talk to them about your PRSI payments and your work history to see what kind of a pension you're entitled to. If there are difficulties within the family or roadblocks and you're trying to get a discussion going and communication isn't working that well, maybe you need to hire the services of a mediator. So if the Mediators Institute of Ireland, you could contact them and they might be able to find a local mediator that would be able to help you. And finally, I suppose the final profession that you will need is an auctioneer, because all of the assets need to be valued in a transfer process. So if somebody was to give me a farm tomorrow, I would need to value the assets that I have, like my car and the house I live in, plus the values of the farm that I'm getting. And all of those go into the calculation when you're doing the tax return. So they're all the professions. And so you wonder, where do you start? So I would say the first thing to do is start with writing a will. And many of us have wills written, but they might have been written 10 or 15 or 20 years ago. So it is important that even if you have a will written, that you review it, because as time moves on, things change. What you thought might happen 20 years ago could be very different now. So it's important, to review your will. And if you don't have one, you should go and make an appointment with your solicitor and organize that. And I suppose a farm transfer or, farm succession, all you're really trying to do is bring the contents of your will, what you're going to do in the future, bring it forward so that, you're transferring the business over for, to give the young person a start, but maybe put assets beyond the reach of the fair deal scheme and, think about, I suppose, what you're going to do in future years. And although policy is aimed at early transfers, we're not saying that you must do it. I would say that you don't transfer a farm to the next generation until you're happy that whatever the younger generation do with the farm, that you can live with those facts and that you have peace of mind. Okay, so it's not a mandatory thing. It's all about good communication among the family members and that everybody is happy at the end of it. So now I just have a list of questions maybe that you might ask the different professions, or maybe there's young people here on the webinar and they want to ask their parents. So the first question is, have you got a will? Have you had a discussion with your family? Do all of the family members know their position? It's often the case that I meet family farmers and I ask them, well, do the family know what you're thinking? And he would say no. And I'd say, well, maybe you should have a chat with them and bring it all out into the open. And it's quite difficult to do. So sometimes a mediator can help with that. I have something else here called a personal affairs checklist. So if you Google the term, you'll find one. But basically, it's a list of things that, important things: bank account, who the family solicitor is, who the doctor is, where the heirlooms are kept, what music you want played at your funeral. It's, so you keep that with a trusted person. You tell them where it is, and it contains all of the important information that's dear to you, that if something were to happen to you, that they can use that list, to organize your care and maybe arrange funeral and, that sort of thing. So it's a good checklist to have. Fifth question, have you made provision for long-term care should you need it? So this is, again, looking at the fair deal scheme, or maybe a savings policy for home care. Not all of us want to end up in a nursing home. It would be nice to be minded at home. But I suppose some of us want to pass in our sleep, without any long-term care. But we don't always get our wishes, so we have to prepare for that. So future income questions. Are you making PRSI payments at the moment to ensure that you are entitled to a full state contributory pension? Do you have a pension plan? If you don't, is it, can you still do that? Is time on your side? Have you discussed the tax implications of the succession with your accountant? Are there any risks to the succession plan? So, you have a plan, but you haven't discussed anything with one of the children, and then it comes to pass. Will you create a war within the family? So it's important, to think about risks. If you delay it and your plan is to pass by will there be a large tax bill received by the person that receives the farm? So what are the risks to it? With the business, will the farm business still be viable when the succession plan is being implemented? Sometimes we hear that a farm is being given to a child, but he must make a substantial payment to other family members. That might put an awful lot of pressure on the farm business, and it might be unviable if there's a large loan to be taken out and some of the farm might need to be sold. So you need to think about, those angles. Can you list the risks that could affect your business? Have you discussed the plan with your legal representative? And have you discussed the cost of completing a transfer? So, if you're dealing with a solicitor, they're obliged, to give you a quotation as to what this will cost. In terms of tax, will the plan result in a tax liability? So there are the 3 taxes I mentioned earlier on. And if it does result in a tax liability, can you adjust the plan so that there's less tax leakage? Because, if there's tax leakage, it's an extra cost in the system, and somebody is trying to start off a business, and, you don't want them to have to sell some land or, to take out a loan to pay tax when really that money could be better spent in stocking the farm or, developing it. So. And finally, are you aware of all the dates and age limits? And I'm sure Brendan will come back to that in the education episode. Generally, Irish tax law is around age 35, and European policy is a young farmer is defined as age 40. So just to check all those dates and age limits in relation to your own family. And do the successors meet the education and time requirements? Many of the tax reliefs that are available, they have an active farmer condition. So it's not just about meeting the education, but you must meet a time requirement where you're an active farmer for part of the time. Even if you're working away from the farm, a certain amount of time might need to be spent on the farm. And maybe there's no successor. And, we come across this quite regularly. So have you considered leasing the farm? In some areas, there's good money available there, tax-free. Have you thought about maybe you still want to do a bit of farm, but you're not as active or physically able? So maybe share farming might be an option where somebody else comes in and you share the profits. Maybe a partnership with a child or a neighbour is another option. And for some, it might be part of the farm might be planted to forestry, part of it might be leasing, and maybe you go helping out a neighbour. So it could be a combination of things. So in summary, I suppose just to say a successful plan will involve lots of communication, and it'll take a lot of time. And just to borrow from Shakespeare, it's better to I suppose, get involved 3 hours too soon than be a minute too late. So I suppose use this webinar as I suppose something to get you started on that road. You've got some information tonight from myself and Deborah. So, when the webinar is over, and over the next number of weeks, make appointments with the different professionals I mentioned. Go talk to myself or your local Teagasc advisor, make contact with Citizens Information, and I'd say the best of luck to you with your plans, because there is a lot involved. If you want to get further information, we have a booklet that you can download from our website. There's actually 2 booklets there, and there's also a link on the website. And Brendan will share the slides with you, but I suppose a very simple way of getting onto our website is just go to Google, type in Teagasc and type in succession, and the farm succession page will be one of the first links that turn up. So click into that and you can see other webinars and other information videos and booklets that we've done in the past. Okay, so.
Thank you very much, James. There, we'll just get you just to stop sharing your presentation. Yeah, that's great. And indeed, thank you very much, James and Deborah, for your presentation. Just while we're waiting for Vivian to come on and do questions and answers, I'm just going to launch a short poll there. Just a few questions there. There's 4 questions there. Have you made a will? So you can answer yes or no there. Do you intend to make a farm transfer in 2024? Again, yes or no there. Do you have an identified successor? Again, yes or no. And if so, does the successor have the green circle completed? So just to get a snapshot of what the views of our online audience. So indeed, at this stage of the evening, I'll now hand it over to our regional manager, Vivian Silk, and indeed, still time to put your questions in there in the Q&A. So good evening, Vivian, and over to you now.
Thanks, Brendan, and thanks to James and Deborah for joining us this evening on this wild and wintry night. A couple of questions coming in, folks. Deborah, I'll go to you first, if that's okay. So the first one is, if your parents are in good health, should a fair deal scheme be spoken about and the parents are around the 70 mark?
And I think myself and James have both covered this. Even though you're in good health, you don't know what's around the corner. But when you're in your 70s, definitely you can rest assured that your parents, if they're anything like mine, have already had that chat and have decided how they want things done as part of their, I suppose they're in their golden years. So they want it stress-free, drama-free. They want it a little bit organized, and they will have had a conversation around how they want things left. And they typically will have, we're adult children in my family now, but we joke in our house that one's in the departure lounge and one's in the waiting room to see if they're going to depart. And then the daughters are running in between like waitresses doing tea, coffees and drinks. So yes is the answer. They should be having conversations.
Okay.
And it would be highly recommended that they do have that. And we always say in citizens information, making a will won't kill you. It's something else that's going to kill you, but making a will and having structure and a framework, it makes it easier for everybody else when somebody passes.
Okay, thanks, Deborah. While you have the mic there, I'll go on to the second one. With regard to the fair deal for a person approved under the scheme, what happens with payment to the nursing home after 3 years expires?
So after the 3 years, the family home is not taken into an account any further. So 3 is kind of like the magic number. Other assets and a new formula and calculation are done by the HSE. Once you cross over the 3 years, then the family home is no longer assessed.
Okay. James, a question for you. Does the young farmer need to have completed the Green Cert in order to be eligible for tax relief and specific grants?
From a stamp duty perspective, you can pay the stamp duty. So you'll be paying the 1% consanguinity relief.
Okay.
And if you complete your education within 4 years and you get your certificate, then you can claim that stamp duty that you paid back from revenue. Okay. With all of the Department of Agriculture schemes, because they're EU based and they want you to upload your certificate when you're applying for the scheme. So for that perspective, you must have your cert, but from a stamp duty perspective, you don't. Okay. So there's time in their hand. And we have kind of a checklist that you can run through, and our education officers have that. So if the client wants to sit down and go through each individual scheme, one of our advisors will be able to do that, Vivian.
Okay. And just more or less on the same topic, James, what minimum age does a child have to be to transfer a farm to? Is there a minimum?
Oh, well, in herd number terms, you can't get a herd number until you're 18. So you can't transfer entitlements or, do any farming until you get a herd number. So I'd say that would be the minimum age.
Yeah, that makes sense. Yeah. Just come back to you, Deborah, and this is a rather long question. We'll maybe break it up into pieces. Where there is an enduring power of attorney, does the power of attorney qualify as the successor? That's the first part.
So I would say there that first of all, enduring power of attorney is a very legal framework. And as part of that legal discussion, you would be declaring your assets. And at that point, any arrangements that are in place around who's going to take care of the person and who's going to be the successor. Because it might be, I have 2 sisters, one of them will do something and I will do something else. So there's no automatic assumption that just because I'm the eldest or the youngest, that it comes to me. But an enduring power of attorney requires a full declaration of all assets and intentions, and you have that conversation. So it wouldn't be an automatic assumption that the person will get it, but if they're the only sibling, or if they're doing the succession planning already, then you would put that into the power of attorney agreement.
Okay. And part 2 of that question, Deborah, and James can come in here if he sees fit. Where there is a partnership in place between a father and son, does the son automatically become the successor, or is it advisable for the son to become the successor to benefit more from the fair deal? Do you understand that, Deborah?
So, this is where I'm saying that, if there is a father and son partnership already in place and then they're going into enduring power of attorney, that should be referenced in that agreement. It's not right to assume automatically it'll go there. But for the successor part, and James might help me here, that's a formal agreement in itself. So you would have to have that in place and bring it to support it for fair deal or for an enduring power of attorney. For the documentation on it, you'd have to evidence it that way. So each of them have their own legal pathway, and then you would bring them all together in a sort of with a ribbon and a bow on it in one final document.
Okay.
Yeah,
Okay.
from the Department of Agriculture point of view, Vivian, if it's a Department of Agriculture registered farm partnership, each party will have a capital account in the partnership. So the child might own all the assets and the parent might own none, or it could be the opposite way around. So, you know, if one of the parties pass away, well, then whatever's in their capital account gets distributed as per their will, you know. So it's not automatic that the younger person gets everything. So it depends on how the partnership is set up. And if it's just, you know, like a giant herd number where two names are on a herd number, they might still own different assets, you know, but the profits of the herd number might be split 50-50 if there's no other agreement. So I suppose it depends on the partnership. And it's important when you're setting up partnerships, be it a simple tax partnership or a complicated Department of Agriculture one, you know, that it's done with the right professional people and everybody knows where they stand. And I suppose, you know, the unwinding of that, you know, people need to have their wills up to date and correct.
Yeah, okay, okay. These two are fairly close related. I'll start off with the more straightforward one first, James. That's okay. What value of a tax-free gift can be passed on to a family member in terms of, I suppose, land area, or that's it. That's what the question is getting at.
With capital acquisitions tax, there's three categories. There's category A, B, and C. Category A is a child. Category B is like a brother or sister, and category C is anybody else. So for category A, a child, which would be the most commonest, which I'll deal with, is 335,000. Okay, which is quite a small amount of money when it comes to farmland. So if you can claim agricultural relief and you qualify for agricultural relief, well, then the value of the gift you receive is reduced by 90%. So essentially, you could transfer a farm worth well over 3 million. And, you know, if the 3 million is reduced by 90%, that's 300,000, which is under the 335,000 threshold. So the majority of farms in Ireland, if everything is structured correctly, it should be possible to pass them from one generation to the next with very little tax due.
Okay, okay, okay. And is the tax applicable on the full value of the farm asset, or is there any specific allowance before the tax applies?
So that 335,000 that I mentioned between parent and child, that element is tax free. So let's say the farm is 5 million. That's coming to you.
Okay.
You haven't used any of your allowance previously. So, and you qualify for the relief. So the 5 million becomes 500,000, which is 500,000. The first 335,000 is tax free. Then you're charged 33% on the balance above that figure. Okay.
Okay. So yeah, it runs into a considerable amount.
Yeah, but it's a large farm, so I'd expect you to trade your way through if you got it.
Yeah, hopefully, yeah. As I used to say to my clients, it's the cheapest land you'll ever get.
Yeah.
Despite the taxes you have to pay on it. Possibly, I don't know, is it this one for you, Deborah, or not? Can you please explain more clearly the difference between a will and an actual transfer? And can you discuss independent legal advice for the spouse of the farmer?
Yeah, so in essence, the transfer can happen when all parties are alive and living, and a will then tends to be executed upon someone's passing.
Okay.
So that, you know, there's nothing, it's like a covenant. It's nothing to stop somebody entering into a transfer arrangement now. And you see there that you can go back over 3 to 5 years to look at how that arrangement was in place. Whereas a will tends to be read after the person has passed away, and it contains their final wishes and gifts of inheritance, really.
And again, sort of a related question. Can I put my farm in a trust instead of into a will?
Okay, so that is you get into a complicated legal area there around trusts, trusteeships, etc. So there's nothing to say yes or no on that. But what I was saying to people is that you would do considerable amount of homework and get a lot of independent legal advice and accounting advice, and go to somebody that does kind of finance brokerage kind of information that will give you long-term forecast on any implications as well for that.
And James, back to you. Or James, have you something to add? Sorry.
I just wanted to add to that. Like if you're a young person and you're a farmer and you have assets and your children are very young, and if you pass, well then your assets, will be left in trust until your children are old enough. So trusts do come into it, but I know from talking to solicitors, once your youngest child reaches the age of 21, it's important that you amend your will, because you could have severe tax implications if your will isn't adjusted when the youngest child reaches the age of 21, I'm told.
Okay. We're coming up to the finish. James, the last question, and we'll wrap it up with Brendan then. There's other questions we haven't got to, and we'll deal with those later, and Brendan will fill you in on that. What type or amount of tax is the parent or the retiring farmer liable for?
Okay, so the retiring farmer is liable to capital gains tax, and there is a relief available. So if you own and farm the land for 10 years prior to passing it, or in some cases, people lease out the land for up to 25 years on long-term leases, you can claim it's called retirement relief. You don't have to retire, but it's called retirement relief. And if you transfer the land prior to the age of 66, there's no upper limit on what you can give a child. If you wait until after 66, you're limited to 3 million. Now, there's a change due in that tax from the 1st of January next year. There'll be a 10 million upper limit for those aged under 66. And I think the age limit is also changing to age 70 on the 1st of January next year.
Okay.
So there's a small change there, but that's the gist of it.
So you more or less answered the second part of that question, which was, what are the ways around this? So yeah, thanks, James. I'll hand it back to Brendan. We're almost out of time.
Thank you very much there, Vivian. Indeed, just to share our results from earlier on this evening there, we ran a poll there. We asked you 4 questions, and we asked you there, I suppose, was do you have a will med? And 62% of you said you did, which is great to see, because I know we ran the same question in 2022, and 50% of you that night each had and hadn't a will med. So great to see an increase there in wills med. Also, we asked you there, do you intend to make a farm transfer? And 20% of you said you intend to make a transfer this year, and 80% of you said you might be a little bit later down the line. Do you have an identified successor? So 67% of you said you did, and 33% of you didn't. And if so, does the successor have a green cert completed? And we had 43% of you said that they had the green cert was completed by the successor. So just some interesting stats there. Indeed, thanks very much there this evening to our 2 speakers, James and Deborah. And as Deborah and James both said, they have more extensive presentations which they will send on to me, and we have the email address there of all the people who registered and attended this evening our webinar. So we will send those by email over the next coming days before the weekend, all going well. So as Vivian said there this evening, our questions and answers literally has lit up in the last 15 minutes, and James and Deborah have answered a lot of questions, but we have some there that we haven't answered, but we will get back to those with an individual response there to each of those senders. I suppose all that's left for me to say, I suppose, at this stage of the evening is just to thank again James and Deborah there for their help. Thanks Vivian there for facilitating the questions and answers. More importantly, thanks to you at home this evening for engaging and staying with us for the night. We had almost 120 farmers there on this evening, so hopefully that you found the webinar beneficial, and we'll get the recording there uploaded in the coming days on our Teagasc Mayo YouTube channel. So indeed, check out that there for all other previous webinars. We'll be here again next Tuesday evening for episode 4 of this series, where my colleague Ronan Mulligan from Teagasc and Claremorris and John McCabe from Teagasc and Tuam will talk to us about the latest changes there in the nitrates regulations, and also preparing for spring grassland management there this spring on Irish dairy farms. So that's all happening next week at the same time, the same link. So it's good night from us all here in Teagasc Mayo, and stay safe, folks, and see you all again next Tuesday evening. Thanks very much, folks. Good night now.
Thank you.